Well, hello everyone. Welcome to Getting Started with Technical Analysis. As someone has said in the chat, guess who's back in town? Well, I am, but I'm in a different town this week. I'm in Bend, Oregon, actually Redmond, just north of Bend, visiting my daughter and her family. So I'll be back in Salt Lake City next week, but I didn't want to miss a whole week of getting to connect with you guys. So I want to thank each and every one of you who has joined us today, both the seasoned veterans, or as I like to call them, the usual suspects. And if you are here for the very first time, please type your greeting into the chat so that we can welcome you to this wonderful community. Today, we are going to be talking about not just trends and moving averages, but I thought we would talk about an introductory stock investing trading plan that is based on trends and moving averages and a little something called the MACD, or moving average convergence divergence indicator. And it's a simple plan that covers both when a trader might decide to enter a position and then when a trader might decide to exit a position. So just before we get into the throes of things, I just want to mention that I have Ben Watson with me in the chat, and Ben is a friend and a fellow coach, and he knows a ton about what we're going to talk about today. He does a lot of live events. I'm going to show you how you can register for those, but you're going to want to follow him on X. His handle, Ben Watson CS. Mine is Barb Armstrong CS. We're posting great content there on a daily basis. It's another way for me to be able to communicate with you and you with me outside of webcasts like this. So I hope you'll take advantage of that. Just before we get into the thick of things here today, just a couple of reminders. One is that everything that we cover in this class is for educational purposes only, none of it to be construed as a recommendation on the part of Schwab or myself. We're not recommending any particular trading strategy or that you invest in any particular stock. We use the Paper Money platform on the Thinkorswim desktop platform, and it is a brilliant place to kind of hone your trading skills, become familiar with the platform and the trading strategies that you might consider using. We're going to discuss the use of stop loss orders today, and know that stop loss orders don't guarantee that you're going to get out at a particular price. They will trigger a market order and you'll get out at the next particular price. So last week, the last 3 weeks actually, we've talked about price patterns, but because today we have a lot of new people joining us, I thought we'd just kind of take a break and go back to trends and moving averages and an example trading plan that we could create together using trends and moving averages. So that's what's going to be on the menu for today. And so we're going to look at different trend types and trend lengths. We're going to introduce some moving averages. We're going to look at some examples and review some of the basic tenets of technical analysis. Now, in addition, I wanted to show you how you can access, and I'm just going to come out here, how you can access our schedule for webcasts, because I know we have a lot of new people here today. And so if you go to schwab.com/coaching webcast, you don't even have to be signed in. And I'll put that in the chat. I'll also put a link down in the show notes below, because a lot of people watch this in the archives. But if you come down here to Tuesday, you can see we're now getting started with technical analysis. And we've got 2 classes to follow it: swing trading with Mike Fairborn, and then selecting an option strategy with Connie Hill. Tomorrow morning, Ben is going to be teaching trading index options, so you'll want to check that out. He does some really interesting stuff in that class. Okay, and then if you have never been to an in-person event, I got introduced to the world of trading at an in-person event back in 2011, and this was one of the first trading strategies I was ever introduced to, or trading plans, shall I say, and that's why I'm going to share it with you today, because this is kind of where I began. So we're going back to my roots a little bit. But we've got an event coming up September 12th and 13th in DC. We're already like stacked to the rafters for that one. But this, if you are a beginner, and lots of people are typing in that they're joining for the first time, so I want to welcome you, that they are beginners. So this would be a great type of event to attend, this technical analysis, 2 days. The first day is an intro to technical analysis. The second day is an intro to options, but this one is pretty full. The next two events I will be attending along with Ben. The first one's in Dallas, and we do still have room there. And then Chicago, these market drives, they kind of look at what's happening globally with the markets. Then they discuss what's happening within our own country. Tariffs might be discussed, for example. Then they'll look at how the individual sectors are doing, and then they'll come right down to individual stocks. So they go from here to here all within one day, and how you as a trader might take advantage of all this information and how you might consider applying that in your investing and trading. When we come out to October, we've got another one of those introductory 2-day events in Orlando. And I mean, you can scroll through. We've got events posted right through the end of the year. And it is free to attend these events. We'll put the coffee on, we'll have breakfast for you, we'll provide a lunch, and they really are worthwhile if you are interested in honing your skills. For me, when I started back in 2011, I had a busy household full of teenagers. And so it was helpful for me to just get somewhere where I could be surrounded by like-minded people who were figuring this out, and be in an environment that was distraction-free. So I encourage you to consider that. Let me just have a quick drink. Okay, so let's go back to our PowerPoint. And this is one of the few classes where I actually, we actually look at a few slides. So here we go. Price moves in trends, and price can go, a stock can really trend 3 ways. It can be uptrending, it can be downtrending, and it can be moving sideways. And really, when we look at trend, if we say something is uptrending, it doesn't necessarily mean the stock is going up every single day. Because when something is uptrending, it might go up for a few days and then pull back for a few days, and then go up for a few days and then pull back for a few days. But overall, we're seeing a series of higher highs and higher lows, and that's what makes our uptrend. And the market kind of discounts everything, or I think of it more as it takes everything into account that is currently known about that stock and the market within which it operates. So the current price is seen as representing everything we currently know about that stock and what's influencing it. Okay. And history, some say history repeats itself, or it at least rhymes. And by that we mean that, given that the market is influenced by human beings, that humans tend to react similarly in similar situations. And so it doesn't mean that we can predict things absolutely, but we can look at patterns and how they repeat over time. Okay. Now, trends also reflect changes in supply and demand. So supply is the number of shares that people are willing to sell, and demand is the number of shares that people want to buy. And when we see that supply is lower than demand, it tends to drive price up. And, so an uptrend reflects strong demand that exceeds supply. And so, you've got to pay more, to be able to get people to be willing to part with their shares. And with a downtrend, it's the opposite. We see a lot of people willing to sell and not as many people willing to buy. And so people keep lowering, the sellers are lowering their price to entice people to buy. Okay, and that that creates a downtrend. Yeah. So when we see a rally, we see that higher demand is driving price higher. And so here we're seeing our price rising, and then we get this equilibrium, or where the stock kind of takes a breather and says, okay, we've driven the price up. And sometimes you'll have institutional buyers that want to take a very large position in a company or in a stock. And so the price goes up, and then they stop buying and let the price pull back a bit. And then they come in and they start buying again. And that isn't always what creates this pattern, but it can help create this pattern. So this pullback or retracement is when, price gets high, it's allowed to fall, and then buyers come back in again. Okay. But when we look at this particular chart, what we are still seeing is a series of lows, and then higher lows and higher lows, and then highs. We had a high, a higher high, a higher high. And then we had this short-term pullback, and then followed by new higher highs. And so, we can have trends within a trend. So the intermediate term trend is uptrending overall, but we had this short-term pullback in the middle. And is that unusual? No, not at all. Okay. Now, there is a survey in the chat today, and if you want to click on that link, I know that Ben will post it again before the end of the session, but there are 2 questions, so it's not like, oh, I've got to, take 20 minutes. There are 2 questions. You rank it from 1, I hated this, to 10, I loved it, and I'm going to keep coming back, and everything in between. And then you have the ability to put comments in. So if there are topics you'd like to see me cover in upcoming weeks, let me know. If you thought the pace was good or a little too slow or too fast, let me know. And, I promise if you fill it out to read each and every comment. Okay, so when we look at uptrend, uptrend is described as being bullish, and again, as I've said in previous slides, it's characterized by a series of higher lows where we have a low and then a higher low and a higher low. So we have a low, followed by a higher low and a higher low. And I will often draw a line on the chart just so I can visually see that. And the same thing with the highs. We have a high, and then a higher high, and a higher high. And a higher high. And the expectation is that the stock is going to continue to go higher, and that you'll profit by buying the stock often when it bounces off one of these higher lows, when it comes back and retests the low, and then you'll get in when it bounces. So, or when it bounces here, or when it bounced here. And if the trend, when is this uptrend no longer an uptrend, is if we stop seeing higher highs and higher lows, and we see, a lower low. What do you do then? Well, that's one of the things that we're going to talk about today. It's one thing to recognize the pattern. It's another thing altogether to know what to do when we see a change in a pattern. And so a downtrend is the opposite, right? Like we're seeing lows followed by lower lows and lower lows. So we have a low here, and then a lower low, and a lower low. And it's the same thing as happening on the high side. We have a high, a lower high, a lower high, a lower high. So we have a downtrending line. Yeah. And some people will, if they trade options, they might use an option strategy to try and take advantage of a downtrend. It's harder to do in buying a stock. So the downtrend, when is a downtrend broken, is when we don't see a lower high, when all of a sudden it comes up and we see a higher high. And, this line could be considered a diagonal line, and we would call that a diagonal resistance breakout. Yeah. So, if you only like to trade stocks, you might say, well, I'm going to stay out of this stock until it stops falling. Okay. So that's a downtrend. What about a sideways trend? Well, a sideways trend is one where we see what? We see similar highs and similar lows. So, if we draw a line here, we have something that is trading in kind of a range where it comes down to a certain low and then seems to bounce. And then it comes up and it hits its head around this high point and it tends to roll over. So it's often called a consolidation period or a neutral trend, where you have equal highs and equal lows. Okay. Now, some traders might use options as a way to capitalize. Some, if you want to stick with just stocks, could say, well, I'm going to buy the stock when it bounces off this support level, and I'm going to sell it. So I'm going to buy here and sell here. Or you might say, hey, I already own this stock. So what I'm going to do is if I own 100 shares of stock, I might say, you know what I'm going to do? When it comes up here, I am going to sell a covered call. And then I'm going to buy it back when it comes back here. And then when it comes up here, I'll sell another one and I'll buy it back when it comes here and I'll sell another one. Now, what is the gotcha? Well, if the stock breaks out and continues to go higher, then you could be called out and end up selling your shares. And if you absolutely don't want to do that, then you might not want to, use that trading strategy. But there are a number of different trading strategies that can work beautifully with a sideways trend. It's being able to recognize the trend and then developing the skill set to understand which strategies might work well. So Kevin is saying, what is a covered call? Well, a covered call is where you have 100 shares, you own 100 shares of stock, or you could buy 100 shares of stock, and then you sell a covered call, typically above where it's currently trading. And so let's say in this example, we sold a covered call up here. So when we sell a covered call, it means we are agreeing to sell our stock at a certain price at any time between now and expiration. And if you'd like to buy our 100 shares from us, let's say this number here is 50. So if we sell a covered call at 52, we're saying, hey, if you would like to pay $52 a share for our shares and buy them from us, you may. And for that, you might get paid, let's say you get paid $2 a share, so you could make $200. And then when it comes down here, let's say this is at 45, that covered call might only be maybe it's worth a quarter. So you might say, well, I got paid $2 to sell that covered call. I'm going to buy it back now for 25 cents, and I've made $175. It depends. So somebody is asking, what's the average percentage you can make on a covered call? I love all these questions. They're great. It could be 1%. It could be 2%. It could be more. It depends on how close the covered call you're selling is to the current price of the stock. It also depends on how much implied volatility there is in the options for that stock. And we talk about that a lot in our Trading a Smaller Account class on Mondays and Fridays. And also there is a class on Tuesdays, it was a little earlier today, called Getting Started with Options. And they take a whole week and just talk about covered calls. Yeah. And I think there's a class on Mondays that's just dedicated to covered calls and short puts. And so you could check that out also. Okay, I'm going to shake my Etch-a-Sketcher. We're never going to get out to the platform today, but I love all these questions that you guys are asking because it means you're thinking about, what I'm talking about. Yeah, well, we can do an example. Okay. So yeah, the focus of this webcast is actually technical analysis. So a moving average, if we put a moving average on our chart, it can help us identify a trend. And so we can see here's a 30-day simple, moving average, and it just helps us smooth out the price fluctuations and makes it maybe a little more obvious that this stock is uptrending. And so if you have a faster moving average, and by that we might say a 10-day moving average, it's going to follow more closely the ups and downs. It's going to be more responsive to price movement, where if you have like a 200-day moving average, it takes 200 days worth of information, the price of the stock over the last 200 days. So it's going to, change much slower. And so, we can look at a long-term trend, an intermediate-term trend, or a short-term trend. And so here's the longer-term trend is uptrending. The intermediate-term trend, we've had some uptrends and some downtrends. And shorter term is less than 3 months. And so if you're thinking like, hey, I'm really looking to generate some income for my account. So really what I want to do is do shorter term trades where I'm in and out in less than, like 2 weeks, 2 to 6 weeks. Then, you might be focusing more on, a 3 to 6 month chart because you're looking at a shorter term time frame. So you want to trade with the trend that matches your time frame objective. And then you may want to look back at the overall trend. So even though you want to do a trend that you're only going to be in for 6 weeks, if the stock has been uptrending for a year, that might lend more confidence to your belief that this stock might continue to be uptrending. Okay. So let's go look at some things on the charts, because I think this is where things can kind of start coming into play. And we're going to start by looking at a 9-month chart on Palantir. And let me just look at our price axis. And we're going to make that a 0. So it'll spread and then I'm going to spread this a little bit. So we're going to come back here. Overall, this stock is up 103% year to date. Okay. So, and Palantir, if we look at the last year, it really has been uptrending. It a year ago was trading at $29 a share, and it recently hit a high of $190. But it kind of had this, when all the tariff shenanigans first kind of hit the fan in February, the whole market pulled back. And then in April, things started to turn around. And so if we said, okay, this has been a longer term trend uptrending, and this is this idea of this shorter term, or intermediate term trading strategy, where we say, and I have got a 30-day moving average on here and a 10-day moving average. And let's come to studies. So I'm going to click on studies, edit studies, and I'm going to get rid of the 10-day moving average because it's just a little distracting. And then you'll see I just typed in simple moving average. And when I added that, I said add selected. I've already got it in here, but the default is for it to be based on the closing price, 30 days, and then this says a yes. But the default is for it to say no. And I want it to show breakout signals. So I'm changing the no to a yes. And then I'm just going to save it and hit apply and OK. And now you'll see if this stock closes below the 30-day moving average, it creates a red arrow. And if it crosses back above, or when it crosses back above, it creates a green arrow. So we saw this stock that, along with the rest of the market, was kind of getting beaten up, and then it crossed the 30-day moving average. And you may have said on that day, well, it may have crossed the 30-day moving average, but I don't know if this is a fake out or a breakout. So I'm going to wait until it comes back and kind of bounces, see if it retests, and see if this 30-day moving average continues to hold as new support. Now, some might have entered on this day. It pulled back and it bounced here. So I'm going to say we entered on this day here, which was April 22nd. And let's say we bought 100 shares. So Priya, we have so much we want to cover in these. What I'd say is you can go back and watch the archives. Okay. And this software that we're using here is the Thinkorswim desktop platform. And so, if we bought 100 shares on this day, how much are we risking? Well, we were paying, it closed that day at $94. So that's a $9,400 investment. And although, it's maybe not likely that Palantir would go to zero, could that happen? It could. So that's what we're risking. So if we said, well, you know what? I think this 30-day moving average, it looks like it's acting as support. So my recent low here was 84.14. So I am going to take that 84.14, which is around that 30-day moving average, and I'm going to multiply that by 0.97. So I'm going to put my stop loss order at about 81.56. And you could make it 5% below, 2% below. We're going with 3 as our example. So now we've made an effort to define our risk by putting our stop at, what was it, 81.56? 81.61. And this is if you want to show that on your chart, you can just write your stop loss order. And I'm going to show that on the right. And then we're going to now, I'm a big fan of know when you're getting out before you get in. And so the stock, you might say, well, as long as it goes up, Barb, I want to continue to own the stock. Well, I would too. Okay. So it starts going up, and then it has this big down day. And, you might have your kind of be going do I get out? Well, is it below the 30-day moving average? So if our rule is we get in if it looks like it's uptrending or a trend reversal and it's moving to the upside, we put a stop in 3% below recent support, which in this case we think is our 30-day moving average. It comes down. Does it close below the 30-day moving average? It doesn't. So what do? We just are patient. Now, might some choose to move it? Yes. And are they wrong? No, they're not wrong. But if our rule is, if it closes below the 30-day moving average, we're going to move our stop up to 3% below the low of that day. So it keeps going up. We've got a nice profit, but it's an unrealized gain. So what the market, giveth, the market can take it away. So on this day, it closes below the 30-day moving average. And where does it close? At 118.93. Now, I already did the math. So that would mean we're going to move our stop up to 115.36. So this is a new stop, and it's going to be 115.36. Now, what did we pay for the stock? Well, we paid when we bought it, we paid about $94 if we bought it on that day. So, we're now the goal is to be protecting some of the profit, but giving it enough room to breathe. If it's just pulling back within the context of an uptrend. So, but we've got an exit in place. And again, this doesn't guarantee we're going to get out at this price. So, it starts going up again. Okay, exit averted. And then on this day, June 27th, it closes below the 30-day moving average again. And so we say, okay, that was 130.54, the low on that day. So our new stop now is going to be 126.62, 3% below. And, we're just going to continue. And, this has all happened within the context of this year. So if we just continue rolling along, so it starts uptrending again. Now, 2 days later, we have a lower low. But if we were to calculate a stop based on this low, we would be lowering our stop. And so one of the rules you may put in your trading plan is that you don't move a stop down, you only move it up. And so in this case, it's like, well, we have our stop at 126.62. We're not going to move it lower than that. Like, we're not going to move it to 124. So we ignore this candle. We see that it's there, but we don't adjust our stop. And then, wow, it starts taking off. Now, when it gets here, would you be wrong to move your stop up to 3% below the 30-day moving average? No. But if you're saying, you know what, I'm comfortable with just, I'll wait till it goes to the 30-day moving average, then on this day, we would have moved our stop. So, and on this day, the low was 156.90. And so then we would have moved our stop on this day to 152.19. And the reason I'm putting this on the chart is so that we can pretty easily see, did the stock go down and hit 152.19? Dang it all, it did. And so we ended up stopped out here at 152.19. And what's it done since then? So it had this, big pullback. We got stopped out. We got in at, sorry, I made a note here, and I guess my notes aren't that great. We got in at 90, it was actually 93.99. So if we got in at 94 and we got out at 152, 152, let's say we ended up getting out at the price we requested, we were up by $58 a share on, a $94 investment. So we were up by almost 62%. And so if we look at that and we say, gee, that worked out pretty well. Now, and I still like this company, and I would like to get back in. What's your rule on when you get back in? Well, if your rule is that you wait until it crosses back above the 30-day moving average and we have a green arrow, do we have that yet? No. So would we say, well, you know what, rules, schmools, I'm just going to buy the stock anyway? Well, you could do that, or you could say, you know what, this trading plan looks like it's working out well for me, so this is what I'm going to do. And so what might we do if, like, let's say that we had bought this in our paper money account, we got stopped out here, we're looking at this, and let's say you're going to go on a little vacation or something, or like you look at your stocks, you spend a couple of hours a week looking at this, but you don't want to miss it. You might say, well, this current 30-day moving average is around 165. So if it goes back above 165, I'd like to get in. And you might say, are you nuts? Like, it's trading at 157. Don't I want to buy it when I'm paying $8 a share less? Well, yeah, but how do you know that it's going to go back up? Wouldn't you rather pay $8 a share more and have more confidence that the uptrend is going to continue? Because, like, we didn't buy this stock, at the low. Like, at a year ago, it was trading at 29. We paid, $94 a share. and we exercise some patience. You don't have to get the whole move. You can get a small part of it and do relatively well. And sometimes you're going to get in and 4 days later, you might end up getting out, and it can be a painful, humbling exercise. So we don't have time, to walk through another example with that kind of detail. But, again, in February and March, a lot of things came down. Starting on April 7th, we now know, hindsight being 2020, a lot of things hit their bottom and started turning around. But if we were employing that rule and we waited for it to cross, and then because it had been a bit of a downtrend, said, I'm going to wait for it to cross and come back. If we'd entered around here, and then moved our stop up, would we still be in this stock? Would we still own our shares? Probably. Because it doesn't look like it's gone 3% below the most recent lows here. That was 263.80. And if we look at 263.80 times, if we stick with that 3% example, that would be 255.88. Well, that would be down below here, 255.88. So we'd still be in. And I encourage you, just pick some different stocks and kind of walk your way through the math. But if we're looking at this now, and we're saying, well, if we have a green arrow that gives us permission to enter, would we have permission to enter today? Well, we actually would, because we haven't seen a red arrow yet, even though today, we have this big candle, and this candle is called a hammer. And a hammer happening at a support level is considered to be bullish. But what we would want to see is tomorrow's candle to be higher. But if we said, well, we're meeting today, we'd like to place a trade, we're going to buy 100 shares of GE, we're going to look at the recent low, and maybe that's here, and use that, we could use that, 255.88 as our exit, because of this red arrow. And it gives us some room for the stock to breathe so that we don't end up nicked out on a candle that, like this one, with a long tail or a long wick, and then see the stock continue to go up. And so again, this stock has been uptrending. It's up 63% year to date. If you would like to see the script, I will put it in the link in the show notes. It's also on my X feed in the post pinned to the top of that feed. But if we look at another way you can see how a stock is doing year to date, well, I'll show you if I have a minute, but let's come to the trade tab. So we are going to right click on GE. We are going to buy custom with a stop. We said 255.88 is going to be our stop. So I'm going to just move this over a bit. 255.88. I'm going to write that down. We're going to buy 100 shares. And when are we going to exit? Well, we are going to exit if it goes below what? Below 255.88. So we are risking, about $20 a share, or about $2,000. Now, this is a $500,000 example account. And so we can have a position size this big, and we can also afford to risk, we're saying half of 1% would be about $2,500, 255.88. We're going to make our stop good till canceled. Now, do stops last forever? They do not. Yeah. So the link for the archive videos. So Maria, if you click the subscribe button, you will have the link. And I know that Ben will repost the link as well. If you go to Trader Talks Yeah, if we go to Trader Talk, so this is our trend trading growth stocks. So stocks growth, we're going to put it in that bucket. We want to buy 100 shares of GE at the current price. We want to sell if it goes down to 255.88 or below. This will trigger a market order. So if it gaps down, we could end up out at a lower price. Okay. And then just because I've been asked multiple times, to get to the archives for this, you're going to scroll down. So you're going to come to Trader Talks from Schwab Coaching on YouTube. And there's a button in the bottom right corner so that you get, there's no cost to subscribe. When you first come, you'll be on the home page and it will show you whatever is currently being taught. So right now we're in Getting Started with Technical Analysis. If you come to playlists, so if you scroll down and this particular class is closer to the bottom of the listings, Getting Started with Technical Analysis, you can see we talked about triangles and pennants last week. We talked about trend reversal patterns. We cover a different topic every week. And then I was gone for 6 weeks. So Mr. Ben Watson was holding down the fort and doing a fantastic job for me. So you can do some binge learning. And then in addition to that, I've done a bunch of short videos, and probably the easiest way to find them, in continuation, they're in the Getting Started with Technical Analysis. But if you come to these trade management mini sessions and view this playlist, I've created a bunch of short videos. So 2 of them just went up last week, but it's what is a hammer? Remember that pattern I talked about on the chart? What is a hammer? It's 5 minutes long. What is a hanging man? 3.5. What is an inverted hammer? So these are just kind of little video bites, if you will. There's a couple on here, the power of investing $5 a day and what that can do for your portfolio over time if you've not checked that out. And then there's a bunch of example trading plans. So here's an example trading plan for covered calls. Here's a simple stock investing trading plan, a bunch for options. And then if you scroll down to the very bottom, if you're new to Thinkorswim, there's a bunch of short videos on how to customize your monitor tab or how to customize a chart or a watch list or all of those things. So you're welcome to check those out. Those are under the trade management mini sessions. So we looked at 2 stocks today. We looked at Palantir and we looked at GE. And with Palantir, what you might want to do is put an alert in to say, hey, when this resumes, if it resumes its uptrend, we'd like to, buy another position. We did do a position on GE, ticker symbol GE, an example trade where we bought 100 shares of stock and put a stock in. And then we walked through how we'd manage that trade once we're in. So you know what? That's a wrap for today. I hope that you guys got something out of this. I encourage you to keep coming back. Please hit the like button. It helps move this up in the trading algorithm so more people can find this content. Subscribe to the channel if you haven't done that already. There is that little survey in the chat. I encourage you to fill that out. I promise to read each and every comment. And then last but not least, don't forget to follow us on X, Barb Armstrong CS and Ben Watson CS. So thanks so much for joining me. Appreciate you being here. Keep coming back. Your financial future and you are absolutely worth it. Take care.